What's going on, my fellow wealth creators? Matty Ice here. Welcome to another training. Today, I want to talk about how infinite banking helps to eliminate or significantly reduce lost opportunity cost in our lives. And I actually meant to talk about this in another video I did the other day, where I was talking about like the main reasons I set up my infinite banking policies, and I somehow forgot to bring this one up because eliminating opportunity cost, lost opportunity costs. I'm sorry. Was a very big reason for me setting up my policies. Once I understood how significant lost opportunity cost is, this was another reason that infinite banking just became a no-brainer to me. Like how much money we lose over our lifetime due to lost opportunity costs and not making these large capital purchases throughout our lives, like buying a car, things like that, not making them in the most efficient way, cost us hundreds and hundreds of thousands of dollars over our lifetime. And you think about how many large capital purchases we make over our lifetime too, it just really adds up. So being able to recapture those dollars through a dividend paying whole life insurance policy and using that for the infinite banking concept, starting to finance our own purchases with these policies, it really helps to put a significant amount of wealth back into our pockets over the long run. So I want to show you a real example of me using my policy in my life. So I one of the first things that I did with my policy when I had it set up is I purchased a vehicle, all right, for $28,000. And what I'm going to do actually is, oops, I didn't share my screen yet. I'm going to pull up a compound interest calculator, and let's actually look at the lost opportunity cost here, like how detrimental the numbers are when we don't purchase things in the most efficient way possible, when we're paying cash or we're doing traditional financing, and we're just giving this money to these institutions, and that money is no longer able to earn interest for us ever again. So that's a real problem. So here's what I did. The vehicle I purchased was $28,000. All right, so we're going to type in 28,000. Okay. And let's do this over 40 years. So I'm 35 right now. Maybe I'm ready to retire at 75. Who knows? Let's just do 40 years. And let's use our interest rate. Let's do an interest rate of 4%, because these dividend paying whole life insurance policies that we set up for infinite banking typically net around 3.5%, upwards of 5% net tax-free compound growth for the life of the policy. So we'll just go, we'll use a number in the middle there at 4%. So let's see how much this vehicle would actually cost me over 40 years, $134,000. If I paid cash and I did not put the money into my policy first, which is going to continue getting that tax-free uninterrupted compound growth. And because what I'm doing is I'm borrowing the life insurance company's money in this scenario here. So my money still works for me. It's still earning interest in my policy, but I'm using the life insurance company's money. I'm borrowing against my policy so that I don't incur this lost opportunity cost here. And the only cost to me is the little bit of simple interest that I pay on that policy loan. Okay, but this right here, like when I first saw this, guys, this started to just blow my mind how much lost opportunity cost adds up in our lives, hundreds and hundreds of thousands of dollars. And by putting my $28,000 into my policy first, so my policy, I'll link down below a full breakdown of my first infinite banking policy if you want to check that out. But I front loaded my policy with 120,000. I had access to roughly about 105 within the first 30 days because I set it up for a high cash value. And so as soon as I did that, that's when I took the policy loan, as soon as I was able to, and then I paid cash for my vehicle. Okay, but I didn't use my own money. I used the life insurance company's money so that my money is actually still in the policy, earning that interest, not losing, like I'm not losing out on all of this interest that I would earn over the next 40 years, right? And when you do this multiple times throughout your life, guys, I mean, we're talking about a significant amount of money. And all I do is pay a little bit of simple interest. It's my current policy loan rate is 5.5% right now, which I think is really good at the moment because interest rates are really high. So interest rates on auto loans right now are pretty ridiculous. Even if you have good credit, it can get up there. So the policy loan rate is actually really competitive, comparatively speaking, than when comparing it to traditional financing options. All right, but here's the thing. Is again, instead of using my cash to purchase the vehicle, or using traditional financing where now maybe I do a down payment, which there's lost opportunity cost for the down payment. But let's say I don't do a down payment and I'm just paying principal. I have a loan over 5 years. Okay, I'm still giving away that principal and interest to another institution, and I'm never, ever going to earn interest on that money ever again. Now, the argument could be that using traditional financing is, especially if you're an investor or business owner and you can get a really low interest rate, and if you can make higher, like significantly higher than the interest rate you're paying, that might still make sense. But either way, setting up these policies first, for all of the benefits that we get, and then using it for to finance our own large capital purchases. Not only can we get a really competitive, potentially competitive interest rate, but lost opportunity cost, which I think is very significant. All right. So now what I want to do is head over to my whiteboard. I want to show you, just walk through a couple, 3 different scenarios that people typically go through when they're making these large capital purchases, like a vehicle. All right. There's 3 main types of ways that you can purchase a vehicle here. And one is through debt. One is saving and paying with cash. And then the third is what I would call wealth creation, like doing it as a making that purchase in a way that turns you more into a wealth creator, eliminating these lost opportunity costs versus the other options that we're typically taught that are not always in our best interest. All right. So let's head over to my whiteboard and let's have some fun. All right, guys, let's have some fun. We're going to draw this out. We're going to talk about 3 different types of people based on how they make their large capital purchases, in this case, the vehicle. All right, so person number 1 is going to be the debtor. This is the person, we get a bank loan, right? Basically, in order to, or an auto loan, in order to purchase the vehicle that we want, and we're going to pay interest on that. So what that looks like, and this was just such a game changer for me when this was first mapped out for me, is so the debtor does not have the cash or the money to pay cash for the vehicle to avoid the interest cost, but they still want or need the vehicle. So they're going to go into debt in order to purchase the vehicle, and over time they're going to make payments on that loan until eventually the loan is paid off, and now they're back to square one. The problem is all this principal and interest that was paid, that's money that is never going to earn interest for this person ever again, which creates that massive lost opportunity cost. All right. Not to mention you paid more for the vehicle than you needed to because you paid interest on it. Okay, so all that money's gone, and they're going to repeat the process. Basically, we're taught to repeat the process over and over and over again. You buy a new car every 3, 4, 5 years or whatever, and they just repeat the process. All right, and every time we do this, we are we're creating that massive lost opportunity cost. All right. So now person number 2 is the saver, and their graph is going to look like this. They're going to save up enough cash, enough money, eventually use all of that cash, use all that money. We're going to deplete the savings account to go purchase the vehicle. And we feel like we've made the best decision here. We've done the right thing because we're not paying interest, like unnecessary interest. And there's definitely an argument for that. The problem is all of the lost interest, which I already showed you the numbers, can just be staggering. Just like how big those numbers can get. The amount of wealth that we lose due to lost opportunity costs can just be massive. And again, we're taught to repeat the process. So we keep saving, something comes up, we make a large capital purchase, we're going to use that cash, we're going to deplete the account, back to square one. And that cash is no longer, that money is no longer earning interest for us. Now, person number 3 is the wealth creator who understands the power of leverage, using other people's money to build wealth. And in this particular case, using somebody else's money to purchase, to make these large capital purchases while still having our money get uninterrupted tax-free compound growth. So we're building wealth, yet we're still making the large capital purchase. And that's because we use a dividend-paying whole life insurance policy structured for high cash value, and we borrow against this in this particular scenario. Okay, in order to make the large capital purchase. But here's what the graph would look like. Here's our money growing every single year, getting uninterrupted tax-free compound growth. So then what we're going to do is we're going to make a policy loan here or we're going to take a policy loan. There's going to be a small, a little, amount of simple interest that we have to pay on that policy loan, obviously. But it's worth it to get this uninterrupted tax-free compound growth. I've done multiple videos on the numbers on this, guys. It is just absolutely incredible how powerful compound interest is when it's uninterrupted. But we're going to pay back that policy loan. Okay, but it's not, when we do that, it's not interrupting the growth of our money. So then we take another policy loan. Okay, we pay that back, but our money is growing the entire time, not to mention the principal payments that we make when when we're paying back the policy loan. That shows up in cash value again, guys, to use again. So the example I like to give here is, let's say we're over here and we get a loan from just a bank, credit union, whatever. If you were to call up the bank and say, hey, all the principal payments that I've made on that loan, I need to borrow again, they would look at you like you're crazy. Otherwise, other than you have to go through another loan application and get approved and all that stuff, but you don't have access to that principal anymore. Okay, that is not the case over here in this situation. When we are making making payments on our policy loan, we instantly restore the cash value that we can borrow against once again. It's so powerful. Now the interest that goes to the life insurance company. You guys, we don't pay interest to ourselves with these policies. I don't know where that came from, but the principal part of the policy loan, whenever you make a payment, that shows up in cash value again to be able to use. All the while, our money remained in the policy because we borrowed the life insurance company's money to make this purchase. Our money is getting the uninterrupted tax-free compound growth while we pay a little bit of simple interest. So simple interest on the policy loan versus compound interest that we're earning. Very, very, very big difference, guys. This is so, it's so much more powerful. That the compound interest is so much more powerful here because we're earning interest on a higher and higher and higher balance when it's compounding versus with simple interest. That interest is being applied to a lower and lower and lower balance over time. So I often I bring this up too. We could have like an 8% policy loan rate over here and only earn 4 or 5% in our policy. But because our policy is compounding and the policy loan is simple interest, we would actually come out ahead. The example I give is when I purchased my car using a traditional auto loan time frame, where typical auto loan might be 5 years. In 5 years, I'm actually ahead when I have only I'm only earning 4%, but it's compounding, and I'm paying 8%, but it's simple interest. I'm actually ahead at the end of the 5 years, even though the interest rate on my policy loan is double what it is for what I'm earning in my policy because it's compounding. It's so powerful, guys. So anyways, I think I'll go ahead and wrap up there. I just wanted to map this out. This is how it was taught to me. It was just a game changer when I learned this stuff. And I learned that I could eliminate those massive lost opportunity costs. I could have my money growing uninterrupted the entire time while I'm still making the purchases that I normally would, but I'm not interrupting the wealth building process. So really, really powerful stuff, guys. If you have any questions, comments, feedback, leave them down below. Make sure you take advantage of all the additional training and resources I have in the description. So definitely check that out. And I will talk to you in the next one. To your success, Matty Ice is out.